Hello, everyone, and welcome to a new episode of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker right here in Silicon Valley, California. Ready to help you with all of your real estate needs, whatever those may be. You can find me over at soldbyrobert.com. Now, this week, we took a little break last week. Last week was a birthday week, so I took some time and had a little fun. I hope you guys had a good week. We actually just did the Coffee and Real Estate live chat this last Saturday at 10 a.m. You can check out the replay on Facebook, Twitter, LinkedIn, YouTube. So feel free to check those out. You can also find links to all of those sources on my webpage again at soldbyrobert.com. But I'm very easy to find on YouTube. Just do a search for Real Estate Realities or Robert Whitelaw, and you will absolutely find me. So feel free to check it out there. We covered some very interesting numbers as it relates to the county overall and sort of drilled down from county level to San Jose to Morgan Hill to Gilroy to sort of get that higher level view all the way down to some lower level view with some smaller communities and some very interesting numbers. And of course, the focus of this show is interest rates, as is, I think, on everybody's mind, what's happening with interest rates, what's going to happen with interest rates. And some folks well, let's go ahead and go with the elephant in the room to start with. And that is everyone talking about how the Fed is going to not raise interest rates in the next go around. Well, honestly, I don't think that has an effect on it, because remember, there is not a direct relationship between the prime rate, which is what the Fed changes one direction or another, and your interest rates you pay on a mortgage. That is more linked to the 10-year Treasury note. And we will be looking at the 10-year Treasury note stuff here in a minute. But that's the primary mover. If you see the 10-year Treasury note going up, then you can fairly confidently bet that in the near future, interest rates are going to go up for mortgages, car loans, everything. So let's go ahead and take a look at it. We'll figure out where we're at. And right now, if we take a look at Mortgage News Daily, what I have now up here on the screen is the average 30-year fixed rate mortgage going all the way back to the early 70s, all the way to today. And it is absolutely nuts. Let's see here. We can see that right now we are at 7.79. I believe if we look up at the top here, it's actually 7.9% for the 30-year mortgage, and it's down 0.01. So it was right at 8%. Now, just keep in mind that the last time that we saw interest rates at this level was November of 2001. Let's see here. Or 2000, excuse me. 7.8. There's October, but I think did it have a little bit of an up? No, that's about right. So all the way back to September of 2000. So it's basically been rates at a level that are higher than anything in the last 23 years. But also keep in mind, historically, we're still in relatively low territory when we go all the way back to, say, the early 70s. I mean, you can see here that interest rates were up around 18%, 17%. One of the big times I've always noted is here in the 1989, 1990, 1991 timeframe. We had this one point where things went below 10% to 9 point something, and suddenly everyone bought because the mindset then was, well, rates will never get below 10% again, right? That we're going to be here at 10% for just some short period of time, and then we'll be back over 10. But we are now at a point where a lot of folks living today who are considering buying their first house that are in their 20s, and I know that from the time I was 0 to 10, it never even occurred to me what an interest rate was. So everybody right now who's in that buying range of 20 something to 30 something is just not calibrated to this idea that the average interest rate over the life of interest rates is more like 10% than it is 2%. So we have to deal with that, right? The psychology of this plays into it. So there is a lot of hesitancy, but also at the same time, we have to realize that at a time when interest rates are going up, home prices are at a ridiculously high point. So one thing we should probably do is calibrate ourselves to, well, what is the 10-year Treasury doing? And what does the 10-year Treasury really affect? Because it actually goes even further than just what you're going to pay for a mortgage. This potentially impacts a whole lot of stuff that could negatively impact the economy moving forward. But as you can see, where we are right now, 23-year high for interest rates, going all the way back to 2020. If we take a look at what the 10-year Treasury note is doing now, we can see that as of just the other day, the 23rd, it was at 4.82, but it hit 5, right? It hit 5%. The high is 5.02. And if we look back at when it was at this height the last time, it's 2006, 2007, and then it took a big drop, right? And we all know what happened in 2006, 2007. That's when we had the real estate crash, which obviously pushed off a more broad economic downturn. And you can see that in the past, this has been even crazier, right? If we go back to the 80s, when we looked at that chart a moment ago, as in terms of what was happening with interest rates, what a coincidence, right? So it's hard to debate the influence of one over the other. So we know what's going on with Treasury notes, and we can also consult with the AP, and I actually highlighted this for us just because it really gives us a good breakdown. Treasury yields have been climbing rapidly, with the 10-year yield rallying from less than 3.5% during the spring and from just 0.5% early in the pandemic. Monday morning, the yield on the 10-year Treasury was at 4.96 after hitting 5.02 earlier. The jump means the U.S. government must, this is what it equals, must pay more to borrow money from investors to cover its spending. Blend that also with the fact that we are still moving forward nationally with gigantic deficits to the tune of trillions. I think it's $1.7 trillion is the number I think I heard. It also directly affects people around the world because the 10-year Treasury yield is the centerpiece of the global financial system and helps set prices for all kinds of other loans and investments. So house loans, car loans. Also think of this as money that gets used for other purposes, business purposes that could negatively impact businesses. Let's see. Besides it making it more expensive for U.S. home buyers to buy a house with a mortgage, higher yields also put downward pressure on prices for everything from stocks to cryptocurrencies. Eventually, they could help cause companies to lay off more workers. And we can talk about that. I have some anecdotal things we could chat about in terms of folks I've been talking to recently where some companies are doing silent layoffs, and they're not really layoffs. They basically create some sort of criteria. And for folks who meet that criteria, they are offered a package to leave. And if you accept it, then great. You're a write-off at some time of the year. Usually it's at the end of the fiscal year. So if it's going to happen, it would usually happen the last 3 months of the year, which coincidentally we're in right now. And I just got off of a phone call with a client, who got offered one of these, and he's accepting it. So he's looking to get rid of his house, move out, move to another state, and he's done. The terms of his were over a year, I believe almost a year and a half worth of pay and 2 years of medical coverage. So they're going to continue to pay for his medical coverage for the next 2 years. So, kind of an awesome deal, but it was his option to either take it or not take it. My understanding is he was saying less than half of the people who were offered these packages took them, but it's something that happens at a variety of different companies all through Silicon Valley, and this is just one example of it. Let's see. Higher yields mark a sharp turnaround for a generation of consumers and investors who've known pretty much low yields, as central banks kept benchmark interest rates pinned at nearly zero. Such low rates let people borrow money more easily, which helped economies to strengthen. Now, what's the downside? And this is the double-edged sword, right? Yes, it facilitated people being able to borrow more, but because there were more people capable of borrowing more, it raised prices. So when we see these influences coming in, where the 10-year Treasury goes up, which obviously means interest rates goes up, that squeezes the number of buyers. Now, what's been interesting is the number of buyers being pushed out of the market in many areas was obscured only by the dropping number of homes on the market. So we've continued to see this low number of homes on the market, and there has been a out of balance in terms of if we have houses on the market to be purchased and we have people who want to buy it, the number of people who want to buy most houses has still kind of remained higher than the number of homes on the market. With this and interest rates now hovering at around 8%, the theory is that we would see this continue to go down. We would see the number of buyers, the buyer side, continue to drop. And at some point that buyers breaking the equilibrium drops to the number of homes breaking the equilibrium, which brings those prices down. And the question in my mind is, is that a subtle process or is that a snap? Does that just sort of hit at some point and things start to go crazy? You know, and obviously I was in the business back in 2006, 2007. I've been doing this since 1988. And things came on pretty fast in 2007, 2008. And it wouldn't surprise me if that tends to happen again, where we simply just see that tipping point switch. So what do you do as a buyer out there or as a seller? So if you're a seller who believes that this market is likely to go down, I think that we are continuing to head into a world where recession is a very high possibility. I think we are heading into a world where even though the Fed may not raise the prime lending rate, I don't see U.S. Treasuries going the same direction anytime soon. What do? Well, if you believe we're at the tippy top as a buyer in terms of interest rates and that they'll only go down from here, well, then you don't worry about it, right? You continue to search for the perfect home for you and you just go with whatever rate is going when you decide it's time to make an offer because you're not worried about interest rates. If you believe interest rates could go higher from here, and remember, this is the graph of interest rates. If you were somewhere right here where you were thinking, well, you know what, we're at 9% interest rates. There's no way it's going to go higher from 9% because these are folks who were used to a 9% interest rate, right? Well, look what happened just a few years after these 9% interest rates, right? We suddenly had 10, 12, 15, 16, 18 interest rates. And we saw a very gradual drop. We tend to see these things tend to be pretty dramatic events. What's interesting is look at the rate of climb here on interest rates. What does that look the most like? Does it look the most like this? Well, not in terms of duration, right? That peaked and went down. Does it look like this? No. And for those of you who are on the podcast, I apologize. I do have these on the video version, but what we're looking at is a 30-year fixed rate mortgage where we peaked in November of 1981 at like 17.8, 18%, 18.45% interest rates with a buildup from 1971 at 7% up that sort of gently went up to there and then sort of went down and went up a little bit in the 80s, mid 80s, and then continued to sort of gradually drop with some peaks and valleys along the way. And it hit its bottom in say December 2020 at 2.7%, 2021, January 2021, and then went up from there. If we go off of history at all, what I'm seeing here is a gradual decline in fixed mortgage rates that seems only able to correct in a more dramatic way. And we're seeing a pretty dramatic increase in here. I mean, just over the last 2 years, we've seen a very dramatic change in what these interest rates look like. And if we go with just, there doesn't seem to be any option to, there we go. So there's 2010, and we can see things were relatively, they were a little bit volatile, but things were jumping to between 4 and 3 and 4 and 3 and 4 and 3, a little bit into 5. Then dramatic drop in 2021. And then just up, right? And I just don't see that being it wouldn't surprise me if this continues to go up or at least stays up in the 7.5 to 8.5 range for a while. So if it's going to stay the same, then as a buyer, you either just say, I'm not going to buy at this, I'm going to wait. Or you say, okay, I'm okay with this, but I need to adjust my strategy. I still need that 3-bedroom, 2-bath house, but I simply cannot afford it where I was looking. So then, and this is advice or observations that I think sellers can benefit from too, because you as a seller need to understand your potential customer, right? Who's the potential person that's going to buy your home? And for those of you who are outside of the core of Silicon Valley, you're not in San Jose, you're not in Santa Clara, Sunnyvale, you're not in Mountain View. For those of you in further south locations that may still be within commuter range of Silicon Valley for folks who have to go in, and return to office is a thing. I am getting lots and lots of conversations with former clients and new clients who are talking about how now they have to do return to office and they are hosed. And this is really so annoying in a lot of ways. So what I'm hearing from folks is there were some folks who were told verbally that, hey, you know what, we're pretty much going virtual, and this was all during the pandemic, and it's working out so well that we are probably you're fine if you decide you want to move to save some money, and you want to do the virtual work person thing, yeah, that shouldn't be a problem. Well, for those folks who didn't get it in writing, and been made officially a virtual employee, those folks are now getting hosed. The reality is that these companies are coming to them and saying, you need to be in the office 2, 3, 4, 5 days a week. The most common number I'm hearing is 3 days or 4 days a week. And it's mandatory. And that is part of your job. And if you can't show up for those days, then you can't do your job with us anymore. So what we're finding is I now have a couple of folks who sold their place up here and moved further south, and it would take them, say, 2 hours, 3 hours to get into work each way. And they're trying to figure out what to do about that. So it's a huge problem. We'll see how this ends up. There's an awful lot of confusion, an awful lot of back and forth on this one. Something I'm hearing a low hum about among folks I talk to. But the offices that have been paying so much for their commercial space and continue to pay for it, maybe paid for 5-year leases or 10-year leases or whatever they kind of lease they got, are finding they're paying for these spaces and not enough of it is getting used. Some companies are trying to take a write-off and simply close off parts of the spaces that they've rented and are committed to. But it really needs to iron itself out. And I don't think anyone talks about it. It's something that, again, I hear as a low hum from an awful lot of people that I talk to. And it's definitely playing into concerns on the part of businesses about recession. Because remember how businesses respond to recessions, or even paranoid ramblings about recession. They tend to want to have more cash on hand. They want money in the bank because they want to be able to weather the storm. To do that, they reduce headcount, they reduce capital costs. And for those companies that might want to do more research and development, that might want to go into a growth mode during a time like this, they don't, because it costs too much to borrow money, right? So this is stuff that negatively affects a lot more than just what we deal with as buyers and sellers. So for buyers, and the other part of this for buyers is, do you believe prices are going to go down? And if you do, then keep searching and then see where the market goes. This winter obviously is going to decline a little bit. Don't take this winter's experience as what's going to happen in 2024. I think the big ticket item, the big period of time that's going to be the indicator of what's going to happen in 2024 is what we see happen in that first quarter, January, February, and March, right? We were talking about this at the beginning of 2023, and we had a very robust first quarter, which surprised me and ended up blowing numbers out of the water that a lot of folks didn't think were going to happen. But we'll see how it goes. Different numbers are in play now. Interest rates are higher. Supply is continuing to accumulate right now. We're listing more homes than we are selling. There was a period of time there where we were selling more homes than we were listing, so we were actually reducing the overall inventory. That's not happening, or at least hasn't happened last month or the month before. So we'll see how much inventory we continue to accumulate. But the funky thing is we still have that super low months of inventory, where if you froze the number of homes currently in inventory and froze the number of homes that sell per month, and then just did the math to how many months would it take with those numbers to sell off the entire inventory, we're still at like 1.5 months, 2 months at the outside for some communities. But my guess is that number is going to go up. So, and with that going up, with inventory going up, eventually that equals a drop in prices. But we'll just have to see how much that drop is. Now, on the upside, and this isn't true across the board, there are an awful lot of folks who, even if a big price cut happens, even if the market does take a dump, are going to be in a position where they would still be able to sell at a profit. They wouldn't be underwater. However, in the conversations, the anecdotal conversations I'm having with folks, that's not what they're going to do. Their interest rates are low. They're at 2 point something or 3 point something percent. Their monthly payment is relatively low, and they'll simply delay their moving plans until the market recovers enough for them to get some of those higher numbers they were hoping for, assuming that happens in a timely way, right? If we go 2-3 years down the road and it doesn't happen, obviously those plans didn't come to fruition as much as they had hoped. But the reality is that it would result primarily for an awful lot of folks in a reduction in inventory rather than an increase. But that's not the only thing in play. Given a downturn like this, a recession like this, a job situation like we've got now, but employment numbers are actually looking good. But in terms of what companies are doing, I think we potentially see more people coming into the marketplace because they have to be in the marketplace, right? We talked a little bit about this in the Coffee and Real Estate live chat on Saturday. The car lending industry, things are nuts, where all the stupid subprime things we saw in 2000, 2004 to 2007 are happening with cars, where we get subprime loans securitized and traded on the stock market, cars having loans on them that are 160% of value. Absolutely idiotic lending in the car world, with people taking home $1,200 car loans. And if you buy a car where you paid $80,000 for it, and now as the car market starts its crash, it's worth $40,000, do you keep making that payment, or do you go out and buy yourself a used car for, and I've done a little poking around, for just a reliable beater that you could take to work that you could buy for $18,000, right? What do you do? And if you do that, what's the financial repercussions of that? Because it's not just your personal income. It's all these banks, it's all these industries that have invested in these holdings of subprime car loans. And there's an awful lot of subprime car lending. In terms of percentage of the overall market, my guess would be it's quite a bit higher even than what was there in the home industry. And then the question becomes, if the housing industry can bring about a gigantic economic implosion like it did, can this kind of financial crash that's spurred by auto loans bring the same thing? And that's an open question. I'm not 100% sure one way or the other. It definitely brings bad things, but it's the scope of the bad things that we'd need to know about, right? So if you're a seller, what's the smart thing to do? Well, I honestly believe that you probably have one more season. You could probably get away with deciding to list your home and sell it in 2024 and get yourself a reasonably good price. Now, the peak was June and July of last year in terms of average sales prices. I think you could get that or right around that in 2024, unless that first quarter really stinks. If we see that first quarter indicator that's down. But what I would suggest is, if you are someone who needs to sell, and I suggested this a year ago, and I think I was right then. If you were someone who had taken my advice and in the beginning of 2023 marketed your home, you would have done a very good job in the markets that I serve. My feeling is that this next year will be on par with last year, meaning we won't see as much appreciation in what homes sell for. We might see a little drop in some areas, but my guess is if we do see any kind of change, it'll be relatively small. It won't be 10% or 20% more than it sold for last year. It might be a couple of percent more than it sold for last year. So this would be a second opportunity for you to potentially back out of your property, pull your profit out of the home, and move on with your life plans, whatever they may be. Now, of course, every situation is different. Every location is different. If you want to get a little bit more detailed view into what your particular situation is, what the market is like in your specific case, and how it performed last year, and then try to extract from that what we might expect in 2024, I'm happy to help you with that. Feel free to reach out to me. You can find me at soldbyrobert.com. But that's really what I wanted to cover today. I think that's an interesting thing. And if you're listening to this in your car, if you're listening to the podcast in the car, once the podcast has ended, that's something to sit quietly and think about for a minute. So in addition to the discussion we had about interest rates, I know I showed a graphic on 10-year treasuries, and those basically have been in decline or really low since 2007, 2006, like when the last downturn hit, and really hit its bottom in 2020, in March of 2020, and has been accelerating up ever since then. So, and it was its peak way back in March of 1981 matches obviously the last big crazy, 17, 18% interest rates that we had during that time. So just so you can imagine in your head what that graph looks like if you don't have the graphs in front of you as I've been presenting this. All right, folks, I hope that's helpful. I know it's difficult. And for all you investors, it's the same rule as always. And this rule never changes regardless of what the numbers are doing, only if the math works, right? It's going to make you buying a single family residential home that you want to turn into an investment more difficult, right? Because the sellers you're going to be dealing with will have an emotional element to it. But if you're looking at a duplex or a triplex or a quad, and someone is selling it for a price where it simply does not work out. In other words, the return on investment is too low, or the return on capital is too low, whatever it might be, right? And you should be expecting yourself to get 8, 9, 10% percent return on your investment. And that's not a greedy thing, because if you're willing to just get 10% or 8, 9%. Usually 10% is what the rate of return is for an indexed fund on the stock market on average. And usually I'd subtract a percent for for inflation. So 9 or 10% is you making at least what you'd make on the stock market without taking into consideration appreciation of the property. So if that's not going to work for you, put it in an index fund instead, if that's where you want to do it. But the bottom line is, if the math doesn't work, if it doesn't cash flow at the price that it's listed, even if you're putting down, and again, remember, it's not just how much you put down, it's how hard that money works for you that's invested in the property. So if you say, well, if I buy it for all cash, it'll be positive cash flow. Yes, it would be positive cash flow, but what would be your return on investment, right? So you got to figure out how much you'd be making, divide that by how much you have in it, and that gives you your percent return on a yearly basis. And if you're someone who's happy with 3%, okay, I guess. But it shouldn't be a negative number, and it should be as close to 10% as possible, right? Because there are other competing places you could put your money that would generate that kind of a return. It's all about the efficiency, right? The best, highest use of your assets, which in this case is cash. Does it make sense to have it all wrapped up into a property? Now, if you as someone who's done this a while and you believe that the property that you're going to buy is going to appreciate at a certain percentage and you're willing to bet on that, and by taking a slightly lower return on investment, that's a decision you can make. But I think in general, particularly with the volatility of the markets we're seeing right now, that is not a safe bet, at least in the near term. And it really depends on how long you plan to hold it. And that's the final piece of advice I'm going to give in terms of buyers. What loan should you get? Now, if you want to buy a home and you want to stay in it for the rest of your life, a fixed rate mortgage. Absolutely. No question about it. And then if interest rates do come back down, simply refinance, right? You've got that option. It resets, which isn't awesome, because remember, when you reset, the beginning of that loan is always lopsided towards interest rather than principal. And that always stinks. And I always suggest, if you have the means up front, to pay more towards interest. So in other words, if you have $1,000 mortgage, you would pay $1,000 and then say drop another $200 that goes straight to principal. That's a great way for you to save money over the life of the loan if you plan on doing a 30-year mortgage and staying with it for 30 years. If, on the other hand, you're going to move in 5 years or 3 years, get an adjustable rate. But make sure that's set in stone, that you're going to do that, because that rate's going to adjust at the end of that 3-year, 5-year period. And then you're going to get whatever the prevailing rate is. And I'm not super confident that in 3 to 5 years, that prevailing rate is going to be lower than where we are now. So in my mind, it's always best to fix the housing cost that you're going to have to maintain for whatever period of time you're going to be doing a thing. So that's a big decision you need to make up front. And if you know for a fact that you're going to be moving within that adjustment window or lack of adjustment window on an adjustable loan, go for it. But if not, if there's any question, you're probably better off getting that fixed loan. Now, of course, you could always refinance at the time when you're supposed to switch over to being a variable, where the variable rate changes. But again, you won't know what interest rates are then. Are they higher? Are they lower? I wouldn't bet that they're going to be lower. Given that chart that we looked at and the history of this particular subject, my guess it goes up from here and potentially goes up quite a bit more. Okay, I think we covered everybody. Buyers, sellers, and investors. Hopefully we gave you some good advice. The goal, as always, is to leave you with more information on the table than we take up in your time, and I absolutely hope that we've achieved that today. I want to thank you all for listening, and I look forward to seeing you all next time.